Every time an international customer checks out, Indian software founders watch up to 15% of their transaction revenue draining away to legacy payment processors. Whether you are a solo indie hacker bootstrapping a tool or a growing SaaS team scaling global subscriptions, the software you use to collect money dictates your margins. The root of this margin loss usually comes down to one specific structural choice: using a merchant of record or more. A merchant of record inserts itself between you and your buyer. Legally, they become the seller. They take on the liability of calculating, collecting, and remitting international taxes, like EU VAT and US sales tax, across hundreds of jurisdictions. Choosing an MOR is a deep architectural commitment. You are trading a significant percentage of every sale for a layer of legal compliance, which often means sacrificing direct control over the billing relationship and your customer data. Today, this choice usually comes down to two models: FastSpring, the established premium model or platform, and Playto Pay, a modern direct payment infrastructure alternative. To compare them, we use this quadrant chart, mapping financial cost against tax complexity. FastSpring sits in the top right, providing a heavy-duty compliance shield for massive operations at premium rates. Playto Pay operates in the bottom left, removing the heavy compliance layer for significantly higher margins. Deciding between the two means calculating your exact mathematical tax liability and matching it to the right fee structure. Merchant of record platforms like FastSpring use an opaque, volume-based pricing model, typically resting around 5.9% plus a 0.95 fixed fee per transaction. That fixed 95 cents becomes a major liability depending on your average revenue per user. This unit economics comparison table breaks down a standard $9.99 monthly subscription. Because of that 95-cent fixed charge, FastSpring takes a disproportionate bite out of small tickets. That high effective rate is also subject to the more refund penalty. When issuing a refund, FastSpring keeps the original transaction fee. You return the customer's money, and you eat the platform fee entirely. High-volume, low-ticket subscriptions are structurally penalized by this pricing model. If your average order value is under $50, you are effectively paying for compliance tools built for enterprise-scale needs you don't yet have. The transaction fee is only the first cut. The second cut happens during cash flow and currency conversion, heavily influenced by the Forex spread. FastSpring operates on a batched payout schedule. Funds are held for 7 to 14 days before they are released to the merchant. When those funds are finally sent to an Indian bank, they typically arrive as a USD wire transfer. Your local bank converts the currency using their own spread, often 1 to 4% worse than the mid-market rate, creating a hidden loss on every payout. Direct infrastructure platforms avoid this friction entirely. A 15% effective transaction rate, followed by a 2-week delay, and a 3% bank conversion penalty, creates a significant drain on the working capital available for payroll or server costs. The main reason founders accept these high fees and administrative hurdles is the fear of being audited or penalized over US sales tax. But legal liability in the US is determined by economic nexus. This is a specific financial threshold you must cross in a state before they require you to collect tax. Looking at this US heat map, that threshold is generally $100,000 in revenue, or 200 distinct transactions per individual state every single year. If your startup generates $50,000 in total US revenue spread across customers from New York to California, you have likely triggered Nexus in 0 states. Paying a 15% platform premium to shield yourself from 50-state tax compliance is a misallocation of capital if your business hasn't even crossed the legal thresholds that trigger the liability. This decision tree breaks down exactly how to structure your payment stack, based purely on the math of your current scale. It starts with one question. Do you have over $1 million in annual international revenue and material nexus across many US states? If the answer is yes, you follow the enterprise protocol. You choose FastSpring or Paddle, and you accept the 8% Morton loss because it is cheaper than hiring a dedicated internal finance team to handle multi-state filings. If the answer is no, which covers 95% of Indian creators and indie hackers, you choose direct infrastructure. It is critical to make this choice early, because migrating subscriptions later introduces MRR churn. When you try to switch away from an MOR down the line, your existing customers are forced to manually re-enter their credit card details on the new platform. Industry averages show that up to 20% of your recurring revenue will not complete this step, causing those subscriptions to cancel. The longer you wait to optimize your payment stack, the more difficult and expensive it becomes to reclaim those margins. Align your payment infrastructure with your actual revenue today.